and ready when you are.
All right. Thank you, Danny. And hello, everybody. Thank you so much for joining us today for our presentation of keeping your debt under control. My name is Alessandra, and I'm a housing counselor at Habitat for Humanity, East Bay, Silicon Valley. And I believe that Danny has uploaded handouts. Is that correct, Danny, on the website?
Yes, I
That
did.
people can, great, thank you. Um, so basically look for those handouts, and also Danny shared a link in the chat about an online evaluation form. So this is an anonymous form that we would greatly appreciate it if you took the time to fill it out. It's a very short form, but it's your opportunity after the webinar, of course, but it's your opportunity to let us know what you thought of this webinar, what you learned, what you enjoyed, things we can do better. We want to hear it all. So please, we greatly appreciate it if you took the time to follow the link and just quickly fill it out. Just a little bit about who we are. We are a nonprofit, and we serve people in Alameda, Contra Costa, and Santa Clara counties. Our organization is a HUD-approved housing counseling agency, and what that means is that we offer a range of services that help people achieve financial fitness. We do this through one-on-one counseling, financial education, group financial education, like today's webinar. We also have an online financial education center, which I'll talk more about later. And we also offer first-time homebuyer classes. These are 8-hour classes that are for people who are seriously thinking of at some point purchasing a home, or maybe are in the process of purchasing a home. Now, with one-on-one counseling, we offer free individualized guidance by a HUD certified housing counselor. And really, it's for anybody who would like to learn how to manage their personal finances, which can include how to create a sustainable household budget, how to balance income and expenses, how to start a saving plan, manage debt. We also offer credit counseling that teaches how to build or rebuild a positive credit history, or how to improve a credit score, and also pre-purchase counseling for people who would like to buy a home at some point and would like to understand how the home buying process works and how to become financially ready to purchase a home. And we have other programs and services. We also have an affordable homeownership program, and we have a home repair services. So to learn about everything that we offer, there's our website. Please visit us at habitatebsv.org. All right, but today we are going to be covering the cost of borrowing. We'll talk about the 2010 debt rule. We'll go over some debt management and payment strategies, and we'll also talk about how to deal with debt collectors. So let's review first some warning signs that you may have a debt problem. All right, first sign, if you don't know how much debt you owe, then it means you probably are, or it may mean that you are avoiding facing the reality of your debt situation, which can lead to debt building up and getting deeper into debt. Now, people avoid knowing for a variety of reasons. Maybe they're resistant to facing the fact that they need to change spending patterns and lifestyle, or maybe they're feeling overwhelmed and unsure how to take the first steps. If they're struggling to even just keep up with expenses, they may think there's no solution. Where would I even find the money to pay it off? And so they kind of give up. And they think, even if I find money, it's going to be so small. It's going to take me forever to pay it off. And so they kind of give up on doing something about it. Another warning signs there's a debt problem is if you rely on credit cards to help cover expenses and keep up with living costs, or even a certain lifestyle. Then that means you're living beyond your means, which means more money is going out than coming in. And if this was your situation, you would need to carefully look at your income and expenses to find a way to balance them. Another warning sign is if you can't pay credit card. Oh, I'm sorry, that's the same title. Apologies about that. But basically, is when you can't pay your credit card balances in full when they're due and can only afford to make the minimum required payment. If that's what you're doing, then it means that you're carrying too much debt and you risk defaulting on your obligations and then getting yourself deeper into debt. Another a sign of debt problems is if you're using as a debt payment management strategy, you're paying one debt with another. Maybe you're doing balance transfers, or maybe taking out a new loan to pay another loan. People who do that are really not addressing the root problem and are just kicking the can down the road. So if this was your situation, then you would need to carefully look at your spending habits and commit to making changes. Let's also review some worst and best practices about managing credit card debt. So here are some practices that you should avoid. Don't use cards to fill in gaps and spend money on things you can't afford. Resist offers from retailers to apply for their credit card just to get a discount. For example, apply today and get 50% off your purchase. If you weren't planning on making that purchase, you're not saving, you're spending money and adding debt. And it could also have a negative impact on your score because they will pull your credit report to review your application. Resist impulse buying. It can lead to spending more than you should or can afford. Before making a purchase, give yourself 24 hours to think about whether you should spend your money on something you really don't need. And chances are you'll realize you should not and be happy to invest your money. Another don't is to use credit cards rewards offer as a reason to spend more. Travel or cashback incentives should not be used as justification for overspending. If you can't afford to pay off the balance when the payment becomes due, then the interest you'll have to pay cancels out the value of the accrued reward. And here are some best practices. So think of credit cards as a form of borrowing. We all say, I paid with a credit card, but except we're not. We're borrowing money. So before using your card, remind yourself that you'll have to pay back the amount you're charging. And if you don't pay the full amount when it's due, then you'll pay high interest on top of it. Also, the small minimum payment that credit card companies require us to make tricks us into feeling comfortable to keep charging. That payment's usually really low, just maybe $25 a month, $30 a month. And so we rationalize and keep charging, and then think, oh, well, I'll just pay the minimum payment. So a good practice is to charge only what you can pay in full. Because if you don't, then you risk getting stuck in a borrowing loop, and then you get yourself into trouble. If you have more than one card, use them on a rotation system. It'll make it easier to keep track of how much you're charging and avoid overextending yourself. So let's say you have a Visa and a MasterCard. So then you use the Visa one month, the MasterCard the following month, and then you repeat the cycle again. And then this way you're keeping both cards active, and you preserve their credit history. And also, but more importantly, it's going to help you more easily keep up with how much credit card debt you're carrying. And avoid deferred interest credit offers. If you don't pay the balance off by the time the deferred interest period expires, you can be hit with retroactive interest charges on the entire balance you charged. So these offers often say 0% interest or special financing. But if you leave even a single dollar of charges on the card, by the time the deferred interest period is over, then the cost can be really, really large. Now, credit cards versus loans. Credit cards and loans both are a form of borrowing, as I mentioned earlier. So, credit cards, you're not paying, you're borrowing. There is, of course, a difference between the two. Credit cards are short-term financing. That means you pay back your debt quickly. The minimum payment you must make varies depending on the balance you're carrying. You pay interest only if you don't pay the full balance when it's due. You can continue borrowing up to the credit limit, and also typically they are unsecured, which means you don't pledge an asset to back up your debt. Loans, on the other hand, are long-term financing because you pay back over a longer period. The monthly payment is based on the loan amount and the interest rate you were quoted when you took out the loan, and provided you have a fixed rate loan, the payment's the same each month. You agree to make a set number of monthly payments until the loan is paid off, and then once the loan is paid in full, you can't borrow against it anymore, so the account's closed. Now, loans typically are secured, which means that they're backed by property or an asset, for example, a home or a car. So if you don't pay back the loan, in addition to legal and credit consequences, you also risk losing the asset because the lender will take it back to recoup some of the money that they lent you. Now, when you borrow money, you'll need to pay back the principal plus interest and fees. The principal is the borrowed amount. In the case of a loan, it is the amount the lender loaned you. In the case of credit cards, it's the amount you charge on the card, which goes up or down depending on how you use it. Interest is the cost you pay to borrow money. It is expressed as a percentage and does not include fees or charges. The interest rate you charge is impacted by the market and your score, your credit score, and the higher your score, the better rates you'll be able to get. Now, when you take out a loan, the lender will quote you an interest rate which can be fixed or variable. That interest rate cost will be included into your monthly payment. If you have a fixed rate loan, it means that the payment will not change for the life of the loan, and this makes it easier to budget for it. If you have an adjustable rate loan, then it means that it will adjust periodically and it could go up or down. So the monthly payment could increase or decrease. And it could also increase to a point where you may not be able to sustain the added cost. So for budgeting purposes, a fixed rate loan is the safer choice. When you charge expenses on a credit card, you pay interest only, again, if you don't pay the balance in full when it's due. When you carry a balance from month to month, interest often accrues daily. That means that every day the interest amount is added to the previous day's balance, so the amount you owe can grow by a lot. And that's why it's important to only charge an amount you know you can afford to pay in full. Keep in mind that the interest rate can change depending on how you use the card. So for example, if you get cash back, it will be higher than if you charge a purchase. It also may increase if you miss a payment or pay late. Now, in addition to paying interest, the financial institution will also charge fees. When you take out a loan, the lender will charge you fees for processing the loan application and reviewing it. And while you pay back the loan, they will charge loan maintenance fees. If you pay late payment fees. Credit cards include fees like annual charges, late payment, and going over the credit limit fees and balance transfer fees. Now, the annual percentage rate, or APR, is also expressed as a percentage, just like interest, but it reflects the interest rate plus fees and other charges. So for this reason, it provides a more complete picture of the annual cost of borrowing. So in the case of a loan, it includes the fees a specific lender charges you for processing the loan. Two different lenders may quote you the same interest rate but charge different fees. So comparing one lender's APR against another lender's gives you a fair comparison of how much each loan will cost you overall. For credit cards, the APR, it's not called the, it refers to the yearly interest only. So for loans, interest and fees, but for credit cards, it only refers to the yearly interest. And it doesn't include fees because it's impossible to predict which fees the cardholder might incur. So depending on how you use your card, you may be charged fees and charges separately. So this slide shows you the how much carrying balances can cost you. As I mentioned earlier, based on the balance that you carry, the credit card company will require you to make a minimum payment, and that payment is very, very low. And most of that minimum payment goes to pay interest, and very little of it goes towards paying back the principal. And that's how credit card companies make money. When all we do is pay the minimum, we pay them a lot in interest. So here's an example that shows how much carrying credit card balances will cost you. So let's say this person has a credit card with a balance of $1,000 and the interest rate is 18%. Now they can't pay the full balance, but they can afford the minimum $25 monthly payment. So they don't worry. They'll just pay $25 a month. I'm sure it'll take longer to pay off, but that's okay. It'll get paid off eventually. However, if they were to calculate how much it will cost them in interest and how long it will take them to pay off the balance, they would be shocked. So assuming that they stop charging on this account, it will take them more than 9 years to pay the balance in full. And because they're paying 18% interest on any remaining owed balance, they'll end up paying $923 just in interest, almost double what their original balance was. So when they make that last payment 9 years later, do they even remember what they bought and are they still using it? Now, of course, ideally, they should only have charged the balance they could afford to pay in full and avoid paying interest altogether. But in this situation, they should do their best to at least pay more than the minimum required payment. And it doesn't take much. Adding even a small amount can make a big difference. So if they committed to adding just $20 to the minimum required payment and paid $45 each month instead of $25, now it will take them a little over 2 years to pay off the balance and will pay $226 in interest instead of $923. And that's a saving of $697 in interest. And apologies, that is wrong on the slide. And they will have shortened their debt repayment period by 7 years. That's just by adding $20 to that minimum monthly payment. They're saving a ton of money and paying it off in way shorter time. Now, owing too much debt can have several negative impacts. It can bring down your score. For loans, the scoring model considers how close your loan balance is to the original loan amount. So as you pay it down, it will help improve your score. And when it comes to credit cards, the scoring model considers how much of your card's credit limit you're using. And the closer you get to that limit, the more your score will go down. Too much debt can negatively impact your credit history. If you can't keep up with the payment, maybe pay late or allow debts to go unpaid, it will report it on your credit report. And a negative account history listed on your credit report, like missed payments and owed debts like collections, is considered a red flag when you apply for rent, credit, loans, even utilities, car insurance, and cell phone plans. So this means that your application may be denied. It can increase your cost of borrowing. If you carry too much debt when you apply for a loan, you may be seen as a higher credit risk and get charged higher interest rate. The higher interest rate, the higher your monthly payment will be, and you also may be required to put a larger deposit as security. So as a rule of thumb, keep your credit card balances at no more than 30% of your credit limit, and of course, the lower the better. So for example, if you have a credit card with a $1,000 credit limit, you should not carry a balance higher than $300. The 2010 debt rule helps you calculate how much you can afford to borrow based on your net income. And it can also help you determine if you're spending too much on debt payments. Now, net income is your take-home pay. That's how much you earn after all taxes and deductions are taken out. And if you're self-employed, it's what you earn after deducting business-related expenses and the income taxes that you'll have to pay. So in this calculation, debt refers to credit cards and loans and does not include mortgage debt if you own a home. So based on the 2010 debt rule guideline, the total debt you owe in credit card and loan balances should not exceed 20% of your annual take-home income. And your total monthly debt payment should not exceed 10% of your monthly take-home income. Now, the higher you go over these percentages, the more you risk falling behind on debt payments and not having enough income to also cover important costs like housing, food, and transportation. And this can lead to having to borrow to keep up with expenses, which can get you even more into debt. So let's review how you can calculate what your maximum debt percentages should be based on net income. So first calculate your monthly take-home pay and then multiply that amount by 12 to calculate how much you earn in annual net income. And then to calculate your maximum total debt load, you multiply your annual income by 0.20. The result is the maximum amount you should owe in total credit cards and loan balances. And to calculate the maximum monthly debt payment that you should make towards paying off debts, multiply your monthly income by 0.10. And the result is the maximum that you should pay each month towards required debt payments. So let's look at an example. Let's say that your net income is $5,000, which multiplied by 12 equals 60,000. That's how much you earn in net income per year. Now you multiply 60,000 by 0.20, which equals 12,000. So that means that you should not owe more than $12,000 in total credit card and loan balances. Next, multiply 5,000 by 0.10, which equals 500. So that means that you should not spend more than $500 a month of your net monthly income towards paying required monthly debt payments. Now, to gain control over debt, you need to first have a clear picture of how much you owe in monthly payments and total balances. So you can use, and then you can use this information to calculate your debt load and compare it to the 2010 debt rule. So using a chart like this example, start by listing all your credit cards and loan accounts. To help make sure that you pay on time, include the date each bill is due. Don't assume it's the last day of the month or the first. So the date depends on the financial institution billing cycle. So make sure that you check your statement carefully so you don't end up paying late. Then write in the monthly payments and balances you owe on each. For credit cards, list the minimum monthly payment you're required to make. And for loans, enter the monthly payment amount you're paying based on your contract agreement. And then calculate the totals, how much you're required to make in monthly payments and how much you owe in total balances. So in this person, in this example, this person has 4 cards with balances and 1 auto loan. In total, they must pay $600 a month towards paying off these debts. And they also calculate that they owe a total of $19,000 in credit cards and loan balances. So using this information, they can now calculate their debt load. So their financial situation is this. Their net income is $4,000 a month or $48,000 per year. They owe $19,000 in credit cards and auto loan balances and must pay $600 a month towards required monthly debt payments. So to calculate what percentage of their home pay is currently going towards debt payments, they divide 600 by 4,000, which gives them 0.15, which multiplied by 100 equals 15%. So that's 5% over a maximum of 10% based on the 10% debt rule. And then to calculate how much of their yearly take-home pay is going towards paying off balances, they divide 19,000 by 48,000, which is their annual net income. This gives them 0.39, which they multiply by 100, and that equals 39%, which is 19% over a maximum of 20% based on the debt rule. So in this example, the next step would be for this person to review their expenses carefully and find as many as possible they can cut or reduce so they can free up money that they can apply towards a debt repayment plan and start reducing their debt load. All right, let's take a little break for a kind of a quick knowledge check, and you can use the chat to write in your answer. Don't worry if you don't know the answer. It's more kind of a midway point to take a breath. We covered a lot of stuff, and make sure that kind of the information is cemented, and just do a review. So I'm going to ask, and if you don't know the answer, don't worry about it. All right, so question number 1. What is the maximum percentage of your take-home pay that should go towards monthly debt payments? So remember the rule. What is the maximum percentage of your take-home pay that should go towards monthly debt payments? Do you remember what that percentage is? There was one for monthly debt payments and one for total amount of owed debt. 10%, perfect. No more than 10% of your monthly net income should go towards paying monthly debts. Perfect. Now, what's the maximum of your annual take-home pay that should be spent on debt? So what's the maximum amount? Let me rephrase that. The maximum amount of total owed balances that you should have based what percentage, what's the maximum percentage of your net income that should go towards paying off total balances or your balances? So I'm totally saying that wrong. In my head, it makes sense, and then it's coming out of my mouth and it's coming out wrong. 20%, thank you. I'm so sorry about that. So no more than the total balances that you owe should equal to no more than 20% of your annual net income. Okay, there, that's better. Okay, what are some negative impacts of carrying too much debt? We covered a few. What can happen when you're carrying too much debt? We reviewed a few things that can happen. You can get quoted higher interest rates, because it might impact your credit history in a negative way, your credit score in a negative way, which means you get quoted higher rates, which means higher payments. If you have too much debt, there's a great risk that you may fall behind on payments, that you can't keep up, and that can kind of snowball, and then maybe you end up falling behind, or you can't keep up with the payments, you pay late, or maybe you can't pay the debt, and so then it goes into collection. And so now your ability to qualify, not just for credit cards and loans, but also for things like rent, services like utilities, cell phone, car insurance, become impacted, and you may have a hard time qualifying. So, and it can lead to legal problems, because if you don't pay your debts, you could get sued. So, so there's a lot of impacts that it can have. All right, thank you so much for participating, and we'll have, at the end of the presentation, we'll do a Q&A too. So if there's anything that I'm covering now that is a little bit unclear, I'm happy to kind of review it again. Now, if you've fallen behind on debt payments, or you're at risk of not being able to keep up, it's important that you contact your creditors right away. It might feel intimidating, but keep in mind that they too have an interest in making sure that you will pay them back, and they very well may be willing to work with you. So for example, they might agree to waive fees like overdrafts and late fees. They may allow you to delay, adjust, or skip some payments. Keep in mind though that if you pause or reduce payments, you'll owe the money you have not paid once the program ends. They might agree not to report late payments to credit reporting agencies so that it doesn't impact your credit history. They might be willing to change a bill payment due date so it better coincides with when you receive income, or maybe split a larger payment into smaller ones, do at different times. By splitting the payments into maybe 2 or 3 payments over the course of the month might help kind of free up money to cover other expenses, and it might make also paying off that debt more manageable. They can also, they might be willing to change a lump sum payment into monthly payments. For example, if you pay car insurance yearly or twice a year, you could change to monthly payments. You may have to pay a small fee, but it can make handling a larger payment more manageable. Now, when you contact your creditors, be prepared to explain your financial and employment situation, how much you can afford to pay, when you're likely to be able to restart regular payments, and your income, expenses, and assets. And be sure that you get any confirmation of agreements in writing. Now, if you find that you are carrying too much debt, you've got options. Of course, handling it on your own is always preferable. So calculate an amount you can afford per month that can go towards paying down debt, and then start paying debts one by one. And we'll talk more about strategies for creating a debt repayment plan in the next few slides. If you need help getting started, reach out to a HUD-approved housing counseling agency. They offer free or low-cost services and can help, and their HUD-certified counselors can help you develop a debt repayment plan that works for you. Debt consolidation combines multiple debts into a single debt. That means that you make one single payment rather than several payments per month, which can be easier to manage. Now, there are 2 primary ways to consolidate debt. A debt consolidation loan is when you take out a new loan to pay off your debt and then pay back the new loan in installments over a set term. Taking out a new loan can be costly because of processing fees, and you may also end up paying a higher rate, interest rate, than what you're currently paying on debts. And this could happen for a variety of reasons, including your current credit score and the loan amount and the loan term. Credit card balance transfers is when you transfer card balances to a card that offers 0% interest or low interest rate. Now, there are some important things that you must consider before you do this. You'll have to pay a balance transfer fee. The 0% or low interest offer is limited, and you'll pay high rates on any remaining balance when the period expires. So you want to be very careful. You must have a very solid repayment plan to make sure that the full balance is paid before that period ends. Also, balance transfers might impact the length of your credit history and how much of your credit limit you're using, both of which can bring down your score. These are things to keep in mind and be careful about. Another option you have is there are nonprofit credit counseling agencies that offer debt management plans, also known as DMPs. These debt repayment plans don't reduce the amount you owe, but the agency negotiates with your creditors, for example, to lower your interest rate or monthly payment, or maybe waiving fees. And then you make one payment to the agency. Now, the DMP will include a fee, and you'll likely need to close your credit card accounts that are included in the DMP. And you also may not be allowed to get new lines of credit while on the plan, which can take 3 to 5 years to complete, really depending on the situation. Another option are debt settlement programs. I don't know that this is an option. This is out there, but I kind of want to alert you to them. These are different from debt management plans. Typically, they're offered by for-profit companies. And what happens is the company negotiates with your creditors to let you pay a settlement or lump sum of money that's less than what you owe to settle the debt. And then meanwhile, you must set aside a specific amount of money every month in a designated account until you have enough savings to pay off any settlement that's reached. This process can take years to complete. Debt settlement can also be risky because if a company can't get your creditors to agree to settle your debts, you could owe even more money in the end in late fees and interest. And bankruptcy is, of course, the last resort. With Chapter 7, you walk away from debt. With Chapter 13, you enter in a debt repayment plan with the bankruptcy court. Now, watch out for debt settlement or debt relief scams. They target consumers with significant credit card debt by falsely promising to negotiate with the creditors to settle or otherwise reduce a consumer's repayment obligations. So here's some warning signs that you may be dealing with the scam. They guarantee they can settle all your debts or provide fast loan forgiveness. They try to collect fees from you before they settle any of your debts or enter you into a debt management plan. They try to enroll you in their program without first reviewing your financial situation. They advertise a new government program, quote unquote. Basically, it doesn't exist. They claim there's a new government program that they represent. They tell you to stop communicating with your creditors, but don't explain the serious consequences. They tell you that they can stop all debt collections calls and lawsuits. So before you enroll in any debt settlement program, enter the name of the company with the word complaints into a search engine, read what others said about it. And you can also check the company out with your state attorney general and local consumer protection agency. And I would say, if you're looking for this kind of help, go with a debt management plan, work with a nonprofit. That's just the safer thing to do. Here's an example of a debt relief scam call. I hope it's going to play because sometimes when there's closed captioning, the audio will not play, but I'm going to try it.
My name is Mark Anderson. This is a notification call from our Department of Tax, Debt, and Financial Settlement Services. There are new programs that can help you reduce or eliminate your debt completely. It is possible that your tax debt can now be considered temporarily non-collectible. You can call me back at my personal desk, 833-312-3247.
So again, remember that this special government program. This is actually a call that I got that I decided to share because it's very typical of these kinds of calls that they make. So before you create a debt repayment plan, first step is stop the bleeding, stop adding to the debt, or you'll be stuck in a never-ending cycle of paying it down and then getting it back up. So stop using credit cards, don't apply for new loans, make a commitment to just focus on paying down balances. Then get a clear picture of how much you owe and how much of your take-home pay is going towards paying off your debts. Knowing this will help you set limits on how much additional debt you should take and take on and assess how aggressive your repayment plan should be. Once you know your debt situation, assess how much you can afford to pay towards paying off debt. To do that, calculate your monthly cash flow. That's how much money is coming in, how much is going out, to see if you have any surplus monthly income that you could apply towards a debt repayment plan. If you find that you don't have extra money available, or maybe not as much as you'd like, review your expenses carefully and identify all those that you can reduce or maybe eliminate altogether, even temporarily, to free up as much money as possible or as much as needed. Now, how much you need to cut them back really depends on your debt load, your debt repayment goal, and financial situation. So for example, you may need to balance debt repayment with keeping up with critical expenses and adding to savings. Once you determine how much you can pay per month towards paying down debt, commit to that amount, and then prioritize your debt's repayment based on which you want or should pay off first. So a few things to keep in mind. Generally, it's better to prioritize credit card debt over loan debt because if you carry a balance from month to month, the interest charges are likely costing you much more than your loan debt. Payday loans should also be prioritized because they carry very high interest rates, much higher than credit cards. And if you don't pay the owed balance, you're going to keep getting charged finance charges. They're going to keep getting added, and this can lead to a debt spiral. Outstanding debts like collections also take priority because they have a negative impact on your credit history and score. And then start paying off your debts, focusing one at a time. Start with the one at the top of your priority list, and then add all the extra money you have available to its monthly payment while you continue paying the minimum required on all the other debts. Now, when the first debt is paid off, you move to the next one on the priority list. Focusing one debt at a time will help you pay off the debt more quickly and will save you on interest, and it will also make it easier to track and manage your debt repayment. Now, when you pay off credit card balances, there are two rapid debt repayment methods that you can use. With the avalanche method, you add all the extra amount you have available to the minimum payment of the credit card that has the highest interest rate. The advantage is that using this method, you save on interest. The disadvantage is that it may take longer to pay off your first debt, and it may be harder for you to stay motivated and keep going. With the snowball method, you add all the extra amount you have available to the minimum payment of the card with the lowest balance. The advantage is that you'll pay off your first debt faster, and it'll be easier to see progress, which can help you stay motivated and keep going. The disadvantage is that you may end up paying more in interest and cost you a little more over time. Now, of course, with both methods, while you're focusing on paying off one card balance, you continue making the minimum payments on the other cards. Now, when picking one method over the other, know yourself. A plan that you abandon is a failed method. So, for example, if the snowball method helps you stay committed because it's easier to see your progress, then it may be a better choice, even though the avalanche method would objectively save you money over time. So let's look at an example of how the rapid debt repayment method works. Now, this example is based on the snowball method. This person has 4 cards. They review their budget, and they find that by cutting back on buying snacks, they can save $25 a month, which they plan to use towards their debt repayment plan. Now, remember, as we saw in a previous slide, adding just a little to a credit card minimum payment helps pay off the balance a lot faster and will save you a lot in interest. So $25, again, sounds like a small amount, but by leveraging it, it will make a big difference. So they start focusing on paying the card with the lowest balance, which is Kohl's. So going forward, instead of paying $25 a month, they'll pay $50 a month. When the Kohl's balance is paid in full, they will add the $50 payment to the minimum payment of the next card with the lowest balance, which is Macy's. So now they'll start paying $100 a month instead of $50 on this card. When Macy's is paid off, they had $100 to the MasterCard, $125 minimum payment. So now they're paying $225. And when that card's balance is zero, they add $225 to the Visa card, $250 minimum payment, and start paying $475 per month. And of course, meantime, they are not adding to the card balances and making minimum payments on the other accounts. Now, if you have outstanding debts, your creditors may contract with the debt collector to help collect past due money you owe, and they could also choose to sell the debt to a collection agency, and then they try to collect money from you. So if a debt collector contacts you, verify the debt, make sure you owe it, and if you do, that you're paying the right collector. If you get a call, don't admit to owning the debt or give any personal information until you get more information. Get the collection agency's information, including their address and phone number. You can also request a debt validation letter. This letter includes legally required information, including who the original creditor was, the original debt amount, the total you now owe, when the account became delinquent, and when the collector obtained the debt. Once you have more information, do your detective work, check with your original creditor to confirm the debt is yours. Ask them if they sold the debt or hired a company to collect it, and if so, get the collection agency's name, contact information, so that you can confirm if the debt collector who contacted you is authorized to collect that debt. Now, if you verify that the debt is legitimate, debt collector is legitimate, and now you're ready to pay, before you contact the collection agency to discuss the repayment, make sure you have the funds to pay. Because if you don't, you risk restarting the statute of limitations periods, and that's the period during which the collector can sue you. Once you know you have the funds available, contact them to work out a repayment agreement, confirm the total you owe because interest may have been added. You need to be ready to pay the full amount, but you can try to negotiate a lower payment amount. Then confirm that the amount you agree on, you will pay, clears your debt, and you will have a zero owed balance, and request written confirmation on both the total that you owe and what you and the collection agency agreed you'll pay to clear the debt. And this will protect you should the collection agency claim in the future that you still owe a balance. After you receive this confirmation letter, send your payment. Don't wait to pay, especially if you agreed on a lower amount, because offers expire. And if you wait too long, they may no longer honor the agreement. Don't pay with like a Shears checks, because you will not have proof they cashed it. Pay with a traceable method like a check, mail payment with delivery confirmation, so that you have proof they received it, and request that the collection agency sends you a payment receipt acknowledging the accounts being cleared. And of course, keep records, paper trails, even notes about phone conversations. Keep those records handy in case you need to prove in the future that you paid the debt as agreed. Now, if you get a collection letter and you believe the debt is not yours or is not legitimate, mail a dispute letter right away. If you wait, the agency can assume the debt is valid and continue all legal collection efforts against you. If you're sued by a debt collector, respond to court documents, because if you don't, the court usually will assume you agree with what the creditor says, and they could issue a judgment against you. And in this case, you may want an attorney to advise you at the hearing. And there are legal aid services that provide no or low cost services. Here are some ideas, some resources for legal aid services that offer low or no cost legal aid. If you go to the American Bar Association, you can also do a search and look for more. For template letters that you can use when you're dealing with debt collectors, you can visit the Consumer Financial Protection Bureau website. They have great templates that can help you for all kinds of situations that you can use to, including the debt validation letter. And know your rights. Debt collectors can only discuss the debt with you, your spouse, or attorney. They can't harass you, like repeatedly call you. They can't threaten to hurt you. They can't use obscene or profane language. They can't lie. For example, tell you that they're going to arrest you or they're going to sue you if it's not true. You can report problems with debt collectors to your state attorney general's office, the Federal Trade Commission, and the Consumer Financial Protection Bureau. Now, while there are many legitimate debt collectors in the financial marketplace, there are also scammers who may try to get you to pay on debts you don't owe or on debts that don't even exist. So here's some warning signs of debt collection scams. They avoid answering your questions about who they are and details about the debt. They charge you fees before they do anything to relieve your debt. They ask you to pay money transfers by money transfer or prepaid card. They say they're a government official and use scare tactics to get you to pay. They ask for sensitive personal and or financial information. They try to get you to pay by threatening to reveal your debts to your family, your friends, your coworkers, or employers. Now, if you suspect a scam, stop speaking to the caller. Don't provide any personal information. Request the caller's name, company name, street address, callback number, and then you can use this information to verify whether they are a legitimate collection agency or a scammer. So let's review some debt management best practices tips. Know how much you owe. Having a clear picture of how much you're paying per month and how much you owe in total balances will not just help you know where you stand, but also will help serve as a powerful reminder to not add any more debt. So use that 20-10 debt rule to help you assess if your debt load's too high. Determine your financial capabilities. How much can you commit per month towards paying off your debt? Do you need to cut expenses? How many can you cut? Pay more than the minimum required on credit cards. Again, adding just a small amount to that monthly payment. It'll save you a lot of interest and help you pay it off a lot faster. Of course, best practice, only charge what you can pay in full. Just because you have a credit limit does not mean you can afford it. Live within your means. If you're using credit cards to keep up with a lifestyle, review your budget and plan expenses in order of priorities. If you're having trouble paying debts, contact your creditors right away, explain your situation, ask if they may be willing to work with you, and if you agree on a plan, make sure that you keep your end of the bargain. And watch out for debt relief scams and recognize the red flags. Now, if you would like guidance on how to create a debt repayment plan, contact a HUD-approved housing counseling agency. Again, their HUD-certified counselors can help you create a plan that's tailored to your financial capabilities and debt repayment goals, and they will guide you through the process. They can also help you establish a savings plan and understand what you can do to improve your credit score and or rebuild your credit history. So we have a knowledge check here, but I think I'm looking at the time and I'm thinking maybe the time is better served for Q&A. I do want to just show you again, remind you about the workshop evaluation. It's really easy. Danny shared the link on the chat. It's anonymous and it's your opportunity to let us know what you thought of the webinar. Give us your feedback and just follow the link. You fill it out. It's just a few short questions and then you click submit and that's all you need to do. I also want to let you know about our Financial Education Center. This is a free financial education resource that's available to you 24/7. It has a library of playlists that cover all kinds of personal finance topics like budgeting, managing credit cards, credit scores, banking basics, loans, even homeownership and retirement planning. And you can create your own personalized playlist. You don't need to create an account. If you would like the system to remember your progress, then you do need to create an account. Otherwise, you can use it as a guest user. The lessons are short, 3 to 10 minutes, but they're interactive. They've got videos and calculators, real case scenarios. So please take advantage of this. And what I can do is I can also put the link in the chat. So that you can have access to it. And this is my contact information. If you would like one-on-one counseling and have that personalized guidance, here's my phone number and email. Jenny also has my contact information, of course. And shoot me an email or give me a call and we can schedule a quick call just to kind of understand what your goals are. We can go into more details what we can do. And then if you decide to schedule your first counseling appointment, we go from there. And again, services are free. We do charge a small fee to pull the credit report if you want credit counseling otherwise, but you don't have to. That's totally optional. Okay, so maybe now I'm going to stop sharing so I can also go and find that link for the Financial Education Center and I can share that with you. And Danny, if people have questions, I'm happy to.
Yeah, I think while you're looking for that link, we still have a little bit of time. So if anybody has questions for Alessandra, please put it in the chat or put it in the question and answer option. And hopefully we can answer it in this time frame. Otherwise, Alessandra has been kind to share her information, and I'm sure she'll love to touch back with y'all. And I also added in the chat, once again, if you missed the webinar worksheets, also Habitat for Humanity survey, Alessandra mentioned. I also added our library survey. We like to know if we're doing well with these programs and how we can improve. And my email, because I definitely want to share the slides and this recorded webinar with you all. So I know there's a lot of information and it's hard to retain everything. So definitely would love to send you all that again so you can digest it. Yeah, Alessandra sent that link. Please check it out if you can or save it to your web browser. But yes, we open up for any last minute questions that you might have that might pertain to you or any general questions that Alessandra has mentioned through the webinar.
Or even if there are things that you'd like to share, sometimes our audience has great tips for kind of strategies they've used, or maybe you'd like to review something that I talked about, kind of go over it a little bit, again. So happy to do that as well. Let's see. I see a couple of questions.
Here's one question from Lonnie.
Mhm.
Do you have any experiences for veterans using the VA program or as a first-time buyers? I think that's
Well, I haven't personally worked directly with the VA homebuyer program, but it is definitely a great program. It is for veterans and their families, and it's a homebuyer program, homebuyer assistance program, that I believe it doesn't require a down payment, and it's a great program. So for sure, if you are a veteran or a family member of a veteran, definitely check it out.
all right. Thank you.
So basically what the VA home buyer program is government, those are government insured loans. So they're insured through the VA. So the VA doesn't provide the loan, but they insure the mortgage. And so the lender is more protected in case the buyer ends up not making their payments or can't keep up with repaying the loan. Then the VA guarantees the loan, so the VA will pay back the lender. And so it makes um, lenders more willing to loan to certain borrowers they wouldn't maybe loan to otherwise.
All right. I don't see any other
Okay.
questions. I think
Okay.
we might be done.
All right.
We did once again provide information in those links. I also gave many of you my email because I know you're all requesting those slides as well as the video. So we're grateful that you'll utilize this information for your own benefit and maybe possibly share that with others. This is all important for our financial future and current time right now. Alessandra, do you want to share anything else before we go?
No, that's all. I can put my email in case some people weren't able to take it down while I had my slide up. Sorry, I have a long name and we have a long website address. Okay, so this is my email, and it is .org. Sorry, at the end. And my phone number is 2034. So you have my contact information in case you're interested in one-on-one counseling.
Awesome. Thank you so much, everybody. Thank you, Mina. Yes, grateful to have you here. And thank you, Alessandra. Always a pleasure to have you.
Thank you, Danny. Always a pleasure to present. Thank you for allowing me to present, and thank you, everybody, for participating.
All right, everybody. Have a great afternoon. We'll see you at our next session. Will be in October. And also we'll hope to see you soon at the library. And also hit up Alessandra at Habitat for Humanity East Bay, Silicon Valley. All right.
All
Thank
right.
you. Take care.
Have a great night. Thank you. Bye.
Bye.